Get ready for the action, because Lam Research Corporation shares have soared 257.5% over the trailing 12 months, placing them among the top performers in the semiconductor space. We dive into why Lam Research is dominating the AI trend, looking at how its Altus ALD tool and Etha platform are fueling the demand for next-generation chips. And we explore the impressive financial results, showing a 41.3% increase in the bottom line.
Stop using your finger for notes, sketches, and edits. This Jam Jake stylus pen gives your iPad a smoother, more precise writing feel with palm rejection so your hand can rest naturally on the screen. It charges fast, works for hours, and comes with replacement tips. Perfect for school, work, or creative projects. Check the link in the comments to grab it on Amazon.
Next up, we look at the shifting landscape of the semiconductor cycle. We examine why timing is everything in this industry, focusing on AEM Holdings Limited and Venture Corporation Limited. We'll analyze the strong performance of AEM driven by its expansion into AI and HPC manufacturing versus the more balanced exposure offered by Venture Corp, weighing the risks and rewards for your portfolio. Then, we turn to the future of chip manufacturing security. Richard Chang, the former CEO of SMIC, issued a stark warning against the blind pursuit of cutting-edge process nodes. Hear why Chang believes that focusing on mature chips is the key to securing China's supply chain, and what this means for the broader industry strategy. And finally, Navitas Semiconductor is making waves. We break down the massive rally in Navitas Semiconductor's stock following a major product partnership with an Indian chip maker. Discover how this move, combined with heavy short covering, is fueling the stock's momentum, and don't miss our expert analysis on this turnaround story. Stay with us for more breaking news. Lam Research Corporation shares are surging, trading near their 52-week high, driven by robust demand for its semiconductor manufacturing equipment and services. LRCX shares have experienced a remarkable 257.5% increase over the last 12 months, significantly outperforming the broader semiconductor industry's 105.2% surge and several key competitors, including Applied Materials, KLA Corporation, and ASML Holding NV. This strong investor confidence is underpinned by Lam Research's critical role in the artificial intelligence revolution. The company supplies the essential tools chipmakers need to produce next-generation semiconductors, including high-bandwidth memory and advanced packaging components vital for powering AI and cloud data centers. Innovations such as the Altus ALD tool and the Etha platform are key to achieving higher performance and density in chip production. Financial performance remains solid despite macroeconomic headwinds and geopolitical risks. Lam Research has maintained quarterly revenues exceeding $5 billion for 4 consecutive quarters, supported by demand from major chip makers like Taiwan Semiconductor Manufacturing and Samsung. In the third quarter of fiscal 2026, total revenues rose 24% year-over-year to $5.84 billion, beating consensus estimates, and non-GAAP earnings per share surpassed expectations. Operational efficiency is also a major driver of success. Expanding manufacturing in Asia has improved margins, with the non-GAAP operating margin rising to 35% in the third quarter. The company's specialized technology in etch and deposition tools for high aspect ratio structures positions it perfectly to capitalize on the growing demand for advanced nodes. Looking ahead, management anticipates over 50% year-over-year revenue growth for 2026, with consensus estimates projecting 25% revenue growth for fiscal 2026 and 29.7% for fiscal 2027. While Lam Research trades at a premium valuation compared to some peers, its steady earnings growth and strategic focus on AI and high-performance computing, HPC, make it a compelling long-term investment. Analysts currently rate LRCX with a buy, suggesting accumulating the stock is a prudent strategy as the company navigates the evolving semiconductor cycle. SMIC founder Richard Chang has issued a strong warning against an uncritical pursuit of the latest cutting-edge semiconductor process nodes, emphasizing the critical role of mature chips in securing China's supply chain. In rare public remarks, Chang cautioned against what he described as a blind pursuit, driven by industry hype, arguing that focusing solely on the smallest nanometer technologies is a fundamental cognitive misunderstanding of the industry dynamics. Chang, the founder of Semiconductor Manufacturing International Corp., SMIC, reflected on the strategic importance of a balanced approach to semiconductor manufacturing. Chang's perspective underscores a pivot towards leveraging mature nodes as a vital component for strengthening China's domestic supply chain security. Chang's career includes a significant tenure at Texas Instruments in the United States before returning to mainland China to establish SMIC in 2000. His tenure as SMIC CEO concluded in 2009, following a protracted trade secrets lawsuit and subsequent out-of-court settlement with rival Taiwan Semiconductor Manufacturing Company. Chang's statement signals a strategic recalibration within the Chinese semiconductor landscape, prioritizing robust, reliable manufacturing capabilities alongside the race for technological supremacy. The semiconductor industry is characterized by volatile boom and bust cycles, making investment timing critical. Recent positive developments, including Intel's strong earnings and optimistic chip demand forecasts, have reignited investor interest in semiconductor stocks, particularly AEM Holdings Limited and Venture Corporation Limited in Singapore. The cyclical nature of the industry stems from demand being linked to economic growth and technological advancements like AI. Increased demand typically leads to supply increases, causing inventory buildup and price decreases. Conversely, demand slowdowns result in inventory overhang and reduced production capacity. Encouraging signs point toward stabilization, driven by strong demand for AI chips and a stabilizing trend in analog chips used in automotive and industrial sectors. Leaders like Intel and Texas Instruments continue to confirm high chip demand. However, supply chain risks stemming from the Middle East conflict and potential economic slowdowns due to inflation could pose headwinds. AEM Holdings Limited offers a more focused semiconductor play, providing testing solutions with partnerships to major chip makers like Intel. Despite historical concentration risk, AEM demonstrated significant bottom-line strength in 2025, with net profit surging 47.8% due to ramping up manufacturing for its AI HPC customer, and a positive swing in operating cash flow. Venture Corporation Limited provides a more diversified exposure, offering electronics manufacturing services across semiconductors, life sciences, and consumer electronics. While its consumer technology segment softened in 2025, the company maintained robust positive free cash flow and a strong balance sheet, albeit with a moderate dip in return on equity. Investors must weigh the risk profiles. AEM is a more aggressive option, showing high growth expectations reflected in its high forward P/E ratio of 55.2x, while Venture Corp offers greater stability with a lower forward P/E of 21.5x. The choice between the two depends entirely on the investor's risk tolerance and time horizon. Ultimately, navigating the semiconductor cycle requires careful analysis of the current phase of the market. While supportive demand signals exist, potential weakness in consumer electronics segments remains a key bear case. Investors are advised to align their investment strategy with their risk profile, recognizing that market corrections can present opportunities for strategic deployment of capital. Shares of small-cap power semiconductor designer Navitas Semiconductor, trading on Nasdaq under the ticker NVTS, experienced a significant rally on Monday, surging 24.5% during trading. This surge was primarily triggered by news of a comprehensive product partnership announced between Navitas and an Indian chipmaker, Scient Semiconductors. The announcement detailed 7 new products for the Indian market based on Navitas gallium nitride (GaN) technology, targeting next-generation power applications. Furthermore, the partnership was positioned as the foundation for a broader GaN portfolio designed to meet the increasing power and efficiency demands of AI infrastructure, industrial systems, consumer power, and e-mobility. This development has been viewed positively, as it lends credibility to Navitas' ongoing business transformation strategy. Over the past year, Navitas has pivoted from designing power chips for mobile phone charging to producing gallium nitride and silicon carbide chips specifically for AI data centers. This strategic shift has negatively impacted near-term results, with revenue dropping 38.6% last quarter to just $8.6 million, as the new high-power products have yet to offset declines in legacy business. The partnership announcement is seen as a validation of this turnaround strategy, potentially signaling future revenue acceleration. Additionally, the stock's movement was influenced by short covering activity. Navitas has maintained a high short interest, standing at 21% of shares outstanding and 28% of the publicly traded float as of April 15. When heavily shorted stocks receive positive news, this often sparks a short covering rally sought by meme stock investors. While the partnership announcement did not include specific financial figures, Navitas' market capitalization has risen to $5.4 billion, representing 135 times its trailing 12-month sales. Analysts caution that current sales figures may not fully reflect the potential financials once the company successfully navigates its transition into the AI data center market.